Silver didn't just fall, it collapsed, 38% erased in hours, gold bleeding alongside it, and right at that exact moment, the metals exchanges went dark, London halted, systems froze, banks glitched, trading delayed coincidence or a deliberate reset. While prices crashed in the West, silver quietly traded far higher in the East, and someone somewhere was buying everything you were forced to sell. This wasn't panic. This was pressure, and if you blink today, you may have missed the warning that decides who survives the next move, and who doesn't. Welcome to Market Metal. Now listen, my friend, if you're watching this and you've lived through a few market cycles already, you know systems don't break by accident, so do me a favor. Subscribe, not for noise, but so you don't face moments like this alone. And tell me in the comments, where in the world are you watching from right now? The event. What actually happened. The event unfolded quickly, but its meaning can only be understood slowly. By the time most market participants realized something was wrong, silver had already fallen at a pace rarely seen in modern financial history. In a single trading session, the price collapsed by more than 1/3 from its recent highs. At the lowest point of the day, silver was down close to 38%. Gold, usually far more stable, declined by roughly 14% in the same window. In dollar terms, the destruction was extreme. The amount silver lost in hours was equivalent to its entire market price not many years ago. This was not a gradual decline. It was not a rolling correction. It was a vertical move. The timing of the collapse mattered. The move occurred late in the trading week, as U.S. equity markets were closing and futures trading was approaching its weekend shutdown. Liquidity was already thinning. Fewer buyers and sellers were active. In such conditions, prices become more fragile. Small imbalances can create large moves. Large imbalances can create cascades. What made this event different was not only the speed, but what happened around it. As prices were falling, trading disruptions were reported at the London Metal Exchange. The exchange delayed the start of trading, citing technical issues. Activity was temporarily reduced at the very moment when volatility was at its highest. For participants attempting to manage risk, place orders, or respond to the price collapse, access was not fully available. This was not an isolated detail. Similar interruptions had occurred before during periods of stress. Only weeks earlier, silver trading on COMEX had been halted for hours due to reported cooling and system problems. Each incident, taken alone, could be dismissed as coincidence. Taken together, they formed a pattern that demanded attention. At the same time, reports emerged of banking system disruptions in Asia. HSBC confirmed a temporary system shutdown affecting services in Hong Kong. Transactions were delayed, access was interrupted. This occurred as metals markets were experiencing one of their most violent weeks in years. None of these facts by themselves proved intent. But facts do not need intent to be important. They only need relevance. The first task in analyzing this event was to separate price action from interpretation. The collapse did not occur because physical silver suddenly became less valuable. There was no announcement of new supply, no discovery of massive reserves, no technological breakthrough that eliminated industrial demand. The real-world use of silver did not change overnight. What changed was behavior. The structure of the modern metals market relies heavily on leverage. Futures contracts, options, and exchange-traded products allow participants to control large positions with relatively small amounts of capital. This structure works when prices move slowly. It fails when prices move fast. As silver began to fall, leveraged positions moved against their holders. Margin requirements were triggered. Automated systems issued margin calls. Positions that could not be funded were liquidated automatically. Forced selling began to feed on itself. Each liquidation pushed the price lower, triggering more liquidations in a self-reinforcing loop. This was not panic in the emotional sense. It was mechanical. As the price fell through key technical levels, stop-loss orders were activated. These orders were designed to limit losses, but in a thin market, they became market sell orders with no guaranteed price. Liquidity disappeared. Bids were pulled. Prices dropped further than most models assumed was possible. Yet even as paper prices collapsed in the West, signals from elsewhere told a different story. In Asian markets, silver traded at a significant premium to Western spot prices. While futures prices in New York reflected forced selling, physical demand in the East remained firm. This divergence mattered. It suggested that the collapse was not driven by a loss of confidence in silver itself, but by stress within the Western financial structure used to trade it. This distinction was critical. Markets are not only places of price discovery, they are also systems of risk transfer. In times of stress, losses are not evenly distributed. They are transferred from those with less flexibility to those with more, from leveraged participants to well-capitalized ones, from short-term holders to long-term accumulators. By the end of the trading day, prices had already begun to recover from the lows. Silver bounced sharply after touching key retracement levels. The recovery did not erase the damage, but it revealed something important. Selling pressure was not endless. Once forced sellers were exhausted, prices stabilized. From a distance, the chart told a violent story. Up close, it told a precise one. Despite the collapse, silver was still significantly higher for the month. Even after one of the largest single-day drops on record, the metal remained up double digits since the start of the year. This fact alone challenged the idea that the bull trend had ended. Trends do not end while still advancing. For serious observers, the question was not whether the move was painful, it was whether the move was informative. Extreme volatility often appears chaotic, but it usually reveals structure. It exposes where leverage is concentrated. It shows which markets rely on continuous liquidity and which do not. It highlights the difference between ownership and exposure. This event did all of that in a single day. What happened next would not depend on headlines or emotions. It would depend on how participants interpreted the signal, whether they viewed the collapse as failure or as a transfer, whether they focused on price alone or on the systems that produced it. The collapse itself was only the beginning of the story. Forced behavior. Why the price moved this way. The most dangerous market moves are not driven by fear. They are driven by obligation. By the time silver was already deep into its collapse, the majority of selling had nothing to do with belief, conviction, or opinion. It was the result of forced behavior, actions taken not because participants wanted to sell, but because they had no choice. This distinction mattered more than any headline. Modern metals markets are built on leverage. Futures contracts, options, and derivatives allow traders to control large positions with borrowed money. In calm conditions, this leverage magnifies gains. In stressed conditions, it becomes a trap. When prices move sharply against leveraged positions, margin requirements rise automatically. Capital must be added immediately, or positions are closed by force. As silver began to fall, this mechanism activated across the market almost simultaneously. Margin calls were triggered first among the most aggressive positions. Those unable or unwilling to post additional capital were liquidated. Each liquidation added more sell orders into an already thinning market. Prices dropped faster. More positions crossed margin thresholds. The cycle accelerated. This was not selling based on analysis. It was selling based on math. At the same time, volatility itself became a weapon. Exchanges adjust margin requirements during periods of extreme price movement. Higher margins mean more capital is required to hold the same position. For participants already under stress, this change alone can force exit, even if their long-term view has not changed. The market was no longer pricing silver. It was pricing risk. This is why the timing mattered. The sell-off occurred late in the week, when liquidity was naturally lower. As futures trading approached its weekend close, fewer market makers were willing to absorb large orders. Bid depth thinned. Spreads widened. Under those conditions, even modest selling pressure could produce exaggerated price moves. But the selling was not modest. Stop-loss orders, designed as protection, became accelerants. When price fell through widely watched technical levels, these automated orders triggered in waves. In a normal market, stop orders meet willing buyers. In this market, buyers stepped back. Orders hit empty space. Prices dropped further than most participants expected was even possible. This was how a decline became a cascade. What made the event even more destabilizing was the absence of traditional circuit breakers. Despite the magnitude of the move, trading was not universally halted. There was no coordinated pause to restore order. Instead, fragmentation ruled. Some venues slowed, others continued. Participants faced uncertainty about access at the worst possible moment. Uncertainty changes behavior. When traders are unsure whether they will be able to exit later, they exit now. When they are unsure whether systems will remain online, they reduce exposure immediately. These are rational responses to structural risk, even if they appear irrational on price charts. Meanwhile, a second layer of pressure was building beneath the surface. Exchange-traded silver products, particularly those not fully backed by allocated metal, function as liquidity reservoirs during stress. When investors sell shares, authorized participants redeem them for physical metal or cash equivalents. In tight markets, this process can redirect metal flows rapidly. As Western paper prices collapsed, physical silver in Asia continued to trade at far higher levels. The price gap created an arbitrage opportunity too large to ignore. Silver sold cheaply in Western markets could be redirected eastward, where demand remained firm and pricing reflected scarcity, not leverage. This created a perverse incentive. The lower Western prices went, the more attractive it became for large players to absorb supply. The selling pressure from leveraged participants effectively subsidized accumulation by better capitalized actors. Weak balance sheets fed strong ones. None of this required coordination. It required structure. At the macro level, additional stressors reinforced the move. Inflation data released earlier in the day came in hotter than expected. This strengthened the perception of tighter financial conditions ahead. At the same time, speculation around future central bank leadership briefly shifted expectations toward a more restrictive policy stance. Markets react not to reality, but to perceived direction. For leveraged positions built on the assumption of falling real rates and abundant liquidity, Even a temporary change in narrative was enough to trigger defensive action. That action translated into selling pressure, regardless of whether the narrative would hold. But here was the critical misinterpretation. The same forces that caused the collapse also revealed its limits. Once forced sellers were exhausted, selling slowed dramatically. Price stabilized not because sentiment improved, but because obligation had run its course. Those who remained were not traders reacting to margin calls. They were holders with no immediate need to act. This is why the bounce mattered. The recovery off the lows was not a sign of optimism. It was a sign that the market had transitioned from forced behavior to voluntary behavior. That transition marked the difference between disorder and structure. For experienced observers, this shift carried a warning. Markets that rely heavily on leverage do not correct gently. They reset violently. Each reset removes participants who cannot tolerate volatility and concentrates ownership among those who can. Over time, this process strengthens trends rather than ending them. The question was no longer whether the sell-off was justified. The question was who benefited from it. Those who were overextended paid the price. Those who maintained flexibility gained opportunity, and those watching closely saw something more important than a price chart. They saw how quickly modern financial markets can move from apparent stability to mechanical chaos, and how little warning is given before obligation replaces choice. What followed this realization would not be decided by price alone, but by the anomalies that appeared at precisely the moment structure mattered most. The anomalies, when systems fail at convenient moments, the market collapse alone was alarming. What surrounded it was unsettling. As silver prices unraveled, the financial infrastructure designed to manage risk began to behave in unexpected ways. Not everywhere, not all at once. But at precisely the moments when access mattered most, parts of the system slowed, delayed, or went quiet. For experienced observers, this was the point where a price event became a structural signal. During the height of the volatility, trading at the London Metal Exchange was disrupted. The exchange delayed the start of trading, citing technical issues. Activity was restricted while prices were moving violently across global markets. Participants attempting to hedge, rebalance, or respond to fast-moving conditions faced reduced access. This was not a theoretical inconvenience. In leveraged markets, minutes matter. When systems pause during stress, outcomes change, losses concentrate, options expire, margin thresholds are crossed. Decisions that would normally be reversible become permanent. The timing was difficult to ignore. This was not the first time such an event had occurred. Only weeks earlier, silver trading on COMEX had been halted for hours following reports of system and cooling issues. Once again, the interruption happened during extreme volatility, not during calm trading conditions. On paper, these incidents were unrelated. Different exchanges, different explanations, different days. But markets do not operate in isolation. They are linked through arbitrage, settlement, and participant behavior. When multiple access points falter during stress, the effect compounds. At the same time, disruptions were reported in the banking system. HSBC experienced a temporary system shutdown affecting services in Hong Kong. Transactions were delayed. Client access was interrupted. This occurred while metals markets were undergoing one of their most violent repricings in years. None of this proved manipulation. Proof was not the point. Probability was. Large financial systems fail randomly, but they do not fail randomly all the time. Patterns emerge when stress exposes weaknesses. When similar failures appear repeatedly during high volatility moments, the question shifts from why did this happen to what does this enable? The answer lay in market structure. Western metals markets rely heavily on paper instruments. Futures contracts, unallocated accounts, and exchange-traded products dominate trading volume. Physical metal changes hands far less frequently than financial claims on metal. In normal conditions, the system functions smoothly. In stress conditions, it becomes fragile. As prices collapsed in New York and London, a different picture appeared in Asia. Silver in the East did not reflect the same panic. Pricing remained significantly higher. The divergence between Western paper prices and Eastern physical demand widened sharply. This gap created a powerful incentive for arbitrage. Metal sold cheaply in Western markets could be redirected to markets where demand remained strong and prices reflected scarcity. This was not speculation. It was logistics. When such gaps appear, large participants act. They do not need certainty. They only need access and capital. Volatility provides both opportunity and cover. Under the noise of collapsing prices, inventory can change hands quietly. This reframed the meaning of the anomalies. Trading delays during extreme moves reduce competition. Fewer participants can respond in real time. Those with direct access, deeper liquidity, and alternative execution channels face less resistance. The playing field tilts, not by design necessarily, but by consequence. This was why the outages mattered more than the headlines. They occurred at moments when price discovery was most sensitive, when liquidity was thinnest, when forced sellers were most vulnerable, when arbitrage opportunities were widest. Whether intentional or not, the result was the same. Advantage shifted toward those least affected by disruption. For retail participants and smaller institutions, the experience felt chaotic. Screens froze, orders slipped, prices moved beyond expectations. But for system-level actors, chaos often appears as clarity. History supported this view. Periods of extreme commodity volatility have repeatedly coincided with infrastructure stress. Not because systems are deliberately disabled, but because they are optimized for efficiency, not resilience. When demand for execution spikes suddenly, weak points emerge. Those weak points always favor scale. What made this episode especially concerning was the concentration of anomalies across multiple layers of the system: exchanges, banks, and settlement pathways. Each layer amplified the stress of the others. At the same time, narratives began to spread. Social media filled with claims of crashes to specific price levels that had not occurred. Artificially generated videos circulated with authoritative tones and fabricated details. Some appeared to predict price moves before they happened. Others exaggerated physical shortages or misrepresented premiums. For serious observers, this was another warning. Information noise increases during structural stress. Confusion benefits those who act quietly. Misinformation distracts from mechanics. It pulls attention toward drama and away from flow. The truth was more subtle and more dangerous. The system had not broken. It had revealed itself. It showed how access matters more than accuracy in moments of stress, how leverage converts volatility into obligation, how infrastructure weakness becomes a transfer mechanism, and how price alone can mislead those who do not understand structure. The anomalies were not the story. They were the signal. They signaled that the modern metals market, like many financial systems, operates smoothly only within narrow boundaries. When pushed beyond them, it behaves in ways that reward preparation and punish exposure. What followed would depend on whether participants recognized this signal or dismissed it as coincidence. Because once anomalies appear during stress, the next phase is rarely calmer. The signal. What this means for serious decision makers. By the time the volatility faded from headlines, the real message of the event was already delivered. Markets rarely speak clearly in moments of calm. They reveal their truth under stress. What unfolded in silver was not merely a price collapse. It was a stress test of the financial architecture that supports modern commodity markets. And like most stress tests, it exposed weaknesses that are invisible during normal conditions. For serious decision makers, this was not a story about prediction. It was a story about positioning. The first signal was behavioral. The collapse demonstrated how quickly choice disappears once leverage reaches a critical mass. Participants who believed they were managing risk discovered that risk was managing them. Margin rules, automated liquidations, and stop mechanisms removed discretion entirely. Selling occurred not because it made sense, but because it was required. This mattered because it revealed who actually controls outcomes during volatility. Those without leverage did not have to act. Those without deadlines did not have to respond. Those holding assets outright experienced discomfort, not compulsion. The difference between exposure and ownership became unmistakable. The second signal was structural. Despite one of the largest single-day declines in history, the broader trend in silver remained intact. Even after the collapse, the metal was still significantly higher on a monthly basis. This was not how markets behave at the end of long advances. This was how they behave when excess participation is being removed. Violent corrections do not end secular moves. They refine them. The third signal was geographic. The divergence between Western paper pricing and Eastern physical demand was not an anomaly to be dismissed. It was a reminder that markets are global, but settlement is local. Price suppression in one region does not erase demand in another. It merely redirects flow. This created a quiet transfer. Silver, that changed hands under pressure in the West, did not disappear. It moved. It moved toward jurisdictions where demand was less dependent on leverage and more connected to long-term accumulation. The shift did not require coordination. It required only incentive. The fourth signal was informational. As the event unfolded, the quality of public discourse deteriorated rapidly. Artificial narratives, fabricated price levels, and automated commentary spread faster than verified analysis. For professionals, this was not surprising. Information disorder always increases when systems are under strain. Noise is not a byproduct of volatility. It is part of its function. Confusion delays response. Distraction weakens judgment. And while attention is pulled toward sensational claims, real positioning occurs quietly in the background. The fifth signal was political and macroeconomic. Speculation around future central bank leadership briefly altered market expectations. Inflation data reinforced the perception of tightening conditions. Geopolitical risk added another layer of uncertainty. Each factor alone might have been manageable. Together, they created a perception of fragility. Markets react to perceived direction, not stated intention. Even if future policy ultimately returns to monetary expansion, the mere possibility of restraint was enough to trigger defensive behavior among leveraged participants. This mispricing of future conditions created the opportunity that volatility delivered. For decision makers, the lesson was not about guessing the next move. It was about understanding asymmetry. Downside moves driven by forced behavior are fast and violent. Upside moves driven by accumulation are slower, quieter, and less visible. Those who focus only on price miss the transition between the two. The transition had already occurred. Once forced sellers were removed, the market entered a different phase. Volatility remained, but its character changed. Price became less responsive to pressure and more sensitive to demand. This shift often precedes continuation, not collapse. But the most important signal was philosophical. This event demonstrated that modern financial markets are not designed for stability. They are designed for efficiency. Efficiency maximizes throughput during normal conditions, but it sacrifices resilience during stress. When stress arrives, efficiency turns into fragility. Those who understand this do not rely on smooth outcomes. They plan for discontinuity. They recognize that assets held through intermediaries behave differently from assets held outright. They understand that paper claims perform well until they do not, and they accept that volatility is not an error in the system, but a feature that redistributes control. From this perspective, the silver collapse was not a warning of weakness in the metal. It was a warning about the structure used to trade it. The implications extended beyond silver. Any market dominated by leverage, intermediated custody, and automated risk controls is vulnerable to similar events. Commodities, bonds, equities, and currencies all share this exposure to varying degrees. The question is not whether such events will happen again. It is where and when. For those paying attention, this episode offered clarity. It clarified who must react and who can wait, who is exposed to obligation and who retains choice, who depends on system continuity and who benefits from its failure. The final signal was subtle but decisive. Nothing fundamental had changed, yet behavior changed dramatically. That is the hallmark of a system approaching a threshold. When small inputs produce outsized outputs, stability is already compromised. Those who dismissed the event as a fluke saw only the price. Those who studied it saw the system. And systems, once exposed, rarely return quietly to the shadows.